This is a question a lot of people want to know the answer to. When will the property market recover? It's a question I'm going to attempt to answer within this video. My name is Shane Fleming. I'm a property consultant based here in Dublin. Welcome back to my channel, or welcome to my channel. I strive to provide honest and upfront advice on what it's like to work in the real estate industry and invest in property. If you want to see more helpful videos on property, make sure you subscribe. In this video, I'm going to attempt to answer an impossible question, and that is, when will the property market recover? I do not actually think that anyone can actually answer this question right now. Also, different markets will respond differently and recover faster, and different sectors within those markets will actually recover at different rates as well. Offices may actually recover faster than retail, and homes may actually recover faster than apartments. While I can't actually forecast how fast the market will recover, I'm going to outline some scenarios. The first important factor to understand is actually knowing when the market has actually hit the bottom. And that's a totally different question, but very relevant. If you know when you've hit the bottom, you will know when it's a good time to buy. I have made some predictions on how far property will fall in another video, which I will link at the end of this video, and I'll put it in the comments below as well. I will also add a poll within this video. I think I figured out how to work this in my last video, and I will be popping up a poll within this video too, so please go ahead and put in your answers. But the question I will be asking in this poll is, when do you think the property market will hit the bottom? I personally don't think that we'll see the bottom for a while. It might be Q2 or Q3 of next year before we actually really see where the bottom of the market is. While I actually have seen falls in the market and asking prices have actually fallen around the country, some of those asking prices have fallen as far as 10 to 20%. A lot of sales have actually fallen through as well, and also office lettings have a lot of them have been put on hold or have fallen out of bed. That said, I'm also seeing some strong demand for homes in different parts of Dublin. Dublin 4 and Dublin 6 actually seem to still have some strong demand, and there is a lot of interest in some areas within Dublin. And some agents are actually achieving great prices at the moment. Even I have actually put a bid in on a property. The bid did actually reflect the risk that's associated with the economy at the moment, but it just shows that there is still a lot of demand out there. While some of this interest may actually be due to the lack of demand, also there's a lot of people out there who are looking for a deal, which is increasing to inquiries and stuff like that. And I also feel that there's a lot of people who've been locked up in lockdown for the last 3 months within their small house or a small apartment, who are absolutely desperate to find something bigger going forward. But I kind of actually feel that the market is still in the clouds a little bit at the moment. But I think that will actually change when reality kicks in, and that reality will kick in when the government stop the 350 support payments, and also businesses reopen and come to terms with the fact that their costs are way higher and their profits are way down. But I think what will really happen when reality kicks in is when major companies start publishing their financial reports with losses of hundreds and hundreds of millions. Price drop predictions are actually all over the place at the moment. They're ranging from 5% to 20%, but I actually think some sectors could even fall further than that. But it will be dependent on sector. Every sector will be impacted differently. So I'm gonna actually try add some graphs to this video to try help explain where the bottom might be and what recovery might look like. I may add them in as detailed graphs, or I might be easier just to put them up on a whiteboard. I haven't yet decided. I'll decide in the editing process. So on the supply side, any successful economy will need the supply of money, goods, services, and people. If you interrupt the supply of any one of these supply side factors, you will cause a shock recession. If you stop capital, remove labor, reduce productivity, you will cause a shock recession. COVID-19 and the lockdown has removed labor and also reduced productivity. The supply of capital has moved from private lenders to government and in terms of state aid. While capital is still there, it hasn't totally stopped yet. There are actually 3 types of shock-shaped recessionary curves: the V, the U, and the L. We want a V-shaped curve, we want to limit any U-shaped curve, and we want to totally and utterly avoid any L-shaped recession curve. So now onto the graphs. This is a V-shaped curve. The economy takes a short but sharp dip because one supply factor has been cut off. In this case, labour due to lockdown. But they can be caused by strikes, weather events, etc. A V-shaped curve means that the economy comes back to where it was quickly. The important factor to achieve a V-shaped curve is that capital stays flowing. We've already seen signs that capital may be slowing. The next curve is a U-shaped curve. This happens when the flow of capital is disturbed but the tap is not actually turned off. It is called a U-shaped curve because you never get back to where you were, but the economy grows at a similar rate as before. But because the economy lost momentum, you never get back to where it could have been. Okay, so think about it this way. Say you are an elite runner and you're training to break the 4-minute mile. You get to actually 4:01, but you suffer a major injury and you cannot run for a year. You go back to training and it takes you another year to get back to 4:01. It is therefore taking you 2 years to get back to where you were. Now imagine you never actually got injured and you actually broke that 4-minute mile 2 years ago and you've been training ever since. You could have actually broken 3:50 by now. So this is the reason they actually call it a U-shaped curve, because the lines never actually meet ever again. And the reason is because you've lost your 2 years of potential training. And it's the same within an economy. You've lost 2 years of growth and therefore you never get back to where you could have been. As capital is likely going to be impacted over the next few years, it's more likely that we will end up in a U-shaped curve. The next shock recession curve is called an L-shaped curve. This is one we must avoid. It happens when capital is disturbed for a number of years and there's little to no new investment, which leads to a period of decline. If capital cannot grow, it leads to an L-shaped recession. This could happen if COVID-19 keeps coming back. If this happens, it will also impact on the demand side of the economy. This must be avoided and can actually be avoided, but the first thing we need to do is we need a number of breakthroughs. The first one is a breakthrough in medical research. A lot of people are actually hoping for a vaccine. I am too. And with the whole world trying, perhaps one can be found. But our track record in actually finding vaccines for this particular type of virus is not good. I think actually I read the only virus that we've actually successfully eradicated from this planet Earth is smallpox. The real hope is a breakthrough in treatment and a drug that actually dramatically declines the death rate. The next important factor to make sure we avoid an L-shaped recession is the supply of capital. States and governments need to step in and make sure that people and businesses actually get the funds that they need. There is actually no point in actually setting up a state body to tackle this because it will take years to get the funds to the right people. And there's also no point in the state asking the banks to step in and provide funds for people. So let's go back and actually have a look at the curves and see how they could impact different property sectors. The V-shaped curve. What property sectors do I see fitting into this graph? The free flow of capital will determine which sectors actually land in this graph. It seems that capital is still available for major office projects here in Dublin and construction has restarted. But it is likely that a number of supply factors will be impacted over the next year or two, and it is likely that even prime properties won't be in the V-shaped curve and most of them will be in the U-shaped curve. I think actually most sectors will land in the U-shaped curve, including offices, residential, student housing, co-living, and even hotels once airlines are back up and running. The hope is that the market will reach a bottom this time next year and growth will start again. A question to be asked is which sectors or which property sectors will end up in the L-shaped curve. I can see many retail developments and properties ending up in the L curve. This means that this sector on the L curve will drop and there will be very slow to no recovery. But this could actually lead to some good opportunities for asset management in the future. The worrying thing about the L curve is it can happen rapidly if capital is stopped. It kind of happened in Ireland between 2008 and 2012. But the worrying thing when you look at history and look at some cities that were forced into a shock L curve is that when investors and landlords pull their cash and development stops, the towns and cities do die. To finish off, if you're buying an investment property, I do think it's important that you take these curves into account when you're looking at whatever property you're looking at and try to figure out what curve it may land on. If you are buying a family home, these shock curves actually are not all that important. The important thing is what you can actually afford. Is it an area you want to live in? Does it have good schools, good amenities, and is it a handy place for you to live and work? Because they are the long-term factors that will actually be more important. I hope you enjoyed this video. If you have any questions, pop them in the comments below. Also, DM me on Instagram if you wish. And if you like this video, please give it a thumbs up and don't forget to subscribe. As always, thanks for watching.